Hi everyone, Ryan Jones here. I want to take a few minutes and show you the screenshots that I'm going to be providing my Platinum subscribers. The screenshots of my PDS tool. This is the software program that I had built in order to find the opportunities for myself. And what I'm going to do is, based on the feedback from my subscribers, I'm going to go ahead and post the covered call opportunities and the put opportunities at the end of the day, every day, on a link, and you can take a look at all the different opportunities at the end of the day, and then you'll have time to either do whatever research you want to do or prepare for possibly taking some trades on your own outside of the official signals that we post through the updates. So what I want to do is I want to take a few minutes and explain what you're going to be looking at so that there's no confusion, you understand, and I'll give you a few tips and hints on what I look for and why I look for it and how to pick which one over another. Okay, so the first thing that you're going to be looking at are the weekly covered calls opportunities. Okay, so it's fairly straightforward. Here's 10/5 of 12. That's the day of the update, and that's the time that the update was made. So we're looking at prices at 2:56 p.m., and that's based on Chicago time, so it's right before the market closes. And we have the symbol. That's straightforward. We have the price of the underlying symbol, the expiration of the options that we're looking at, obviously 10/12. And then we have the strike, price of the option, the bid, the ask, the last, and then this is the extrinsic value of this, and it's based on the bid because that's where you're going to be selling it at. And then you have the max flat gain. So if on this particular instance we buy Q core at 1943 and we turn around and sell a 1950 strike call for $1, then the gain, the potential gain on this particular position, if on 10/12 the market closes at 1943, the particular gain on this is 5.147%. So in basically 5 trading days, you'll make 5% if Q core trades at 1943 or above. Okay, so that's what that is showing, and then you can see that there's a list, and this is sorted, by the way, by the max flat gain. So this is the best opportunity on the board right now with the weekly options. And there's a list here, and then it shows comparisons. So there's more than one Q core. And the reason that there's more than one Q core is because the orange shaded options are out of the money, and the green shaded options are in the money. And if I'm given the choice between two, one that's out of the money and one that's in the money, I'm going to prefer the in the money. So let's take a look at the in the money and I'll show you why. So here's Q core trading at 1943. Here, this is a 19 strike call. So this is in the money by 43 cents. The bid is at 125, so you're going to pull in a little more on call option. And the extrinsic value is at 82 cents. Okay, so there's 43 cents here of basically intrinsic value. Now, the potential return is based on the extrinsic value, not the bid on in the money calls. So the return is slightly less than the out of the money covered call option. But let's take a look at why I prefer in the money as opposed to out of the money. With an in the money call, I will make the 4.2% as long as the market closes on expiration date at 19 or above. Okay, so in other words, it can drop 43 cents and I'm still going to make the 4.2%. Whereas on the Q core out of the money covered call, if on expiration date the market drops and closes at 19, I'm going to lose 43 cents on the stock and I'm going to gain $1 on the option. So my net is going to be plus 57 cents as opposed to 0.82 cents. So I'm actually going to make only about 3% if the market drops, whereas in this instance, I'm going to make the 4.2% as long as the market closes above 19 So I have 43 cents of downside room, and I'm still going to make the maximum gain. Okay, so that's really one of the biggest reasons why I prefer in the money covered calls as opposed to out of the money covered calls. Then you also have greater downside protection. So you actually don't start diminishing that potential return until it drops below 19, but it can drop a full 7.2% before you hit your break-even level. Okay, so it can drop basically $1.25, and you'll hit your break-even level. Whereas if it drops a buck in the out of the money, that's when you'll hit your break-even level. So you have a lower break-even level within the money call. So it all depends on, here's the max flat gain, and here's the max flat gain for the in the money. There's a slight difference. It's less than 1%. The only other difference is you also have an extra 7 cents in profit potential if the market moves up. So if you really think the market's going to move up, then you're going to be a little better off with the out of the money covered call, because you'll make about 7 cents on the stock as well as the full dollar. So you make $1.07 on that particular one. So a little bit higher of a profit potential. Okay, so that's what you're going to be looking at. You can see there's several opportunities here. I list them all. It shows the potential return on all of them. Then the other window that you're going to be looking at is a window that shows the put option. Now, there is some confusion with selling naked puts, and part of the confusion is just simply when some traders hear the word naked options, they begin to ball up in a fetal position. They begin to sweat, big drops of sweat, because they begin to get nervous. But no reason for any of that, because selling a naked put is more safe than buying the underlying stock, right? So you can outright buy the underlying stock, and if it goes down, you're still going to lose money, right? If you sell a put, it can go down, and you may not lose money. You may still make money. So what we're doing is we're selling puts, and it's the exact same thing as a covered call. As far as the potential return, how it works, how the return works, how the protection works, it's exactly the same as a covered call. The difference is that there's only one transaction. And if there's only one transaction, then you don't have two bid asks that you're going to get smacked on, because when you sell an option, you're going to sell it at the bid, and when you buy the stock, you're going to buy it at the ask. So you're going to get hit on the bid ask on two different transactions, and you have commissions on two different transactions. So if given the choice between a covered call and a put, all things being equal, I'm going to sell the put every time. I would much rather sell puts than put on covered calls. So why would I put on a covered call at all? Because sometimes the covered calls and the dynamics of it offer a higher return. But if I have a covered call that is going to give me 5% potential profit, and a put that's going to give me a 5% potential profit for basically the same downside protection, I'm going to sell the put. So here's a list of the puts, and you can see most of them are the same markets as we saw with the calls. So we have Q-Core here, again trading at 1943 at the time of the update. Here's the strike. So this is an in the money put option, 1950. The bid is 115, and the extrinsic value, because it's in the money, is 108. So this actually offers a better return than putting on the covered call, and so I'm going to put this one on instead of the covered call, if that's the choice that I want to make. So on this particular one, it's at 5.5%, almost 5.6% profit potential, and there's only one transaction. So that's the one I would choose. Now, if you look at the 19, let's take a look at the 19. It's trading at 1943. The strike is 19, so that's out of the money. And the extrinsic value is at 95. The bid is 95, so the extrinsic value is at 95, and it's out of the money. and the profit potential is at 4.8%. Now, here provides more downside protection, and you're going to have to ignore this protection. I need to have the programmer fix that because that's wrong. So ignore that for now on the put side. But nonetheless, if the market drops to 19, I still make all 95 cents. Okay, so I still make 4.8%. So here again, this put option has a higher return. It's not 4.1%, it's 4.8%. And I still make that entire 4.8% all the way down to 19. So between all four of the Q-Core potentials that we've looked at, I'm going for the 19 put. And I'm always looking more for the out-of-the-money puts. I would rather sell an out-of-the-money put than an in-the-money put because, again, it gives me that extra protection. And so if the return difference is not too drastic, then I'm going to go for that extra protection and do the out-of-the-money put. Now you can see the in-the-money put here is at 4.2, and even further in the money put is at 4.2%. Let's see if there are any other Q cores in here. No, there's no more. There's no other Q core in here. Okay, so that's how I make the decision on what puts. You can see there's several other markets that are included here. Zynga was not involved in the call option. It was not available in the covered call, so we have about 3.6% available with selling a put in Zynga. And the only thing with the cheaper stocks, you're risking less, but you're paying more commission. You can only bring in 10, 15, 20 cents on these lower price stocks. So if you're paying too much in commission, that's going to put you out of range for placing some of these lower price stocks, which are very good, by the way. I can't recommend a broker. All I'm going to do is tell you that we use IB, and I'm not a huge fan of IB except for their commissions. So their platform, I really don't like their platform at all. But their commissions, I put up with the platform. I'm on these options. Sometimes I'm paying 62 cents an option, so I can trade these smaller ones, and I'm going to be fine with regard to the commission. Okay, so that's what you're looking at when you see the two screenshots that I'm going to be providing at the end of every trading day. I don't know how long I'll provide them, but for now I'll just throw it in as added benefit to your Platinum subscription, and then we'll go from there. I may increase how often I update the web page. We may update it more as we go forward, but for right now I'm just going to do it once at the end of the day, and then we'll go from there. All right, I hope you enjoy this, and I hope you enjoy the extra added benefit to your subscription with these screenshots. Thanks a lot.